Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Chris Rossbach of J. Stern, the CIO for the World Stars Global Equity Fund. So welcome, Chris.
Thank you.
Yeah, well, given the ongoing sort of like central bank interest rate hikes and sort of like the recent bank credit tightening alongside sort of the contraction in M2 money supply offset by China reopening and the enduring sort of consumer spend and cooling inflation, what's your sort of like outlook for equities going forward?
Well, I think we take a very long-term view in terms of our approach. We look for stocks that have quality and value over the long term. And by long term, we mean 5, 10, and 25 years. So for us, we basically pick up what one of our favorite quotes is from Charlie Munger, who says, micro, looking at stocks is what we do, and macro is what we put up with. And we certainly have had to put up with a lot of macro. But I think based on the work that we do on the stocks and their businesses and their opportunities, we're still very constructive about stocks. We think that we've taken the hits in a lot of ways. We've taken the hit in terms of the inflation that's a result of the pandemic, the bottlenecks, and of the spike in the commodities prices, including because of the invasion of Ukraine. And we think we've also taken the hit on the interest rates because we've seen in the States they're much closer to where they're going to end up than where they were coming from. And so regardless of whether they have a bit more to go or whether we're close to being there, we think we've done that. And then the other hit we've taken is on valuations, because you can see last year we had a significant pullback. Some of that was related to business-specific issues about some companies, but a lot of that was multiple compression with people repositioning themselves short-term because of the spike in interest rates that we had. And so all of that hit is taken. We've had a massive rebound from the lows in November already, but we still think that we're in an environment where corporates are reporting good results, whether there's a slowdown or not, and where valuations are attractive. So we're very constructive about stocks.
Yeah, well, there's a few of your companies have already started reporting some good results, so we'll come on to that moment. But just top level, in terms of valuation, with the S&P sort of like trading at about 18 times this year's earnings, you must be quite bullish then for 2024, because I know the sort of the analysts are saying we're going to get double-digit earnings growth next year, but sort of the more pessimistic view is that it's going to be pretty flat. But you're expecting a good 2024, are you?
Well, I think in aggregate, we're expecting it. But again, we also invest in companies, not in markets. So we pick stocks, and we think that the companies that we've got that have the ability to grow, to reinvest in their businesses, they have the ability to pass on pricing because they've got pricing power, and because they've got scale so they can absorb some of the cost increases. We think those companies are going to be well positioned. But we're definitely in an environment where there's going to be winners and losers. So there are going to be losers as well. We've seen some again this year in the form of the banks, in the form of the energy companies. Some of the stocks that have done so well last year are among the worst performers. So, but if you look outward, we think that the earnings growth for the companies we've invested in is going to be very respectable. And I think what underlies your question on the valuation in terms of the 18 times, I think we have to just look at it, and we think that an environment in which we're in, which is where we may have interest rates around 4 to 6%, and we're not even there, where we have inflation running at 2 to 4%, so elevated, certainly not the 0 to 2% that we've seen, and real interest rates, which ultimately is what really matters to anybody, whether you're a big institution or whether you're a saver, with real interest rates around 0 to 2%. We think that's a world to look forward to, not a world to be afraid of. And if you think of how we go about calculating these multiples using CAPM, then 18 times is completely in line with that for a sensible business that has more or less average growth. So we think that the valuations, even at a market level, are perfectly fine. And if you can then have companies that can do better because of higher growth, because of turnaround, because of things that they can do in terms of improving their business, then they're very attractive opportunities.
Yeah, I think you raise a really, really good point that I'd highlight to investors. I mean, just looking at the portfolio, you're investing in secular growth rather than cyclical growth. And I think a lot of the sort of the champions that the portfolio has is really sort of turbocharged by that secular growth. And let's just go into one of them. It's sort of technology, which I know has done really well for you. Nvidia, which is well known, obviously, to the sort of crowd, but it's a sort of like the crown jewel as much as anything of the whole, silicon chip market. And I think it's about 50, 60, 70, 80%, I think, this year. What's your sort of latest view on that? Because it's just had a turbo boost with the AI, regenerative AI, hasn't it?
Yeah, absolutely. But again, I think the investment thesis for Nvidia is based on a very long-term view in terms of the need for computing capacity and for the competitive position that they have in their GPUs. So we think they're exceptionally well positioned. We think that we're just at the very beginning. If you think about it, look, we've had globalization. We can argue about where we are. And we're in the middle of digitalization, and we can argue about how far that's come. But I think one of the things we've seen from ChatGPT, and that's obviously just writing, right? The other AI engines that we have for speech, for images, for videos that we're still about to see, and then the actual applications. Which are the Internet of Things, which we've known about for a while. It's the metaverse, which I think is going to be a completely different and better way of accessing the digital experience. And it's AI in all its forms, mean that there's tremendous demand for computing capacity. And the NVIDIA chips are uniquely positioned to take advantage of it. So we think that from that perspective, there's a lot of demand. And I think the other perspective is that there's also a big realignment that's taking place in the semiconductor industry, where it's going to matter a lot more where you get your chips from. So there's a large investment going on. That's why we bought ASML. We might touch on that.
Yeah.
But we think in aggregate, there's tremendous demand. And if you look at what happened to NVIDIA, we bought it in February of last year. So yes, you're now saying, well, it's up 70%. It's up 140% from November 3rd, more or less. Well, NVIDIA's low might have been a little lower. I'm thinking of Meta. But from the lows of last year. So yes, it's been an absolute winner, and we took advantage of it. We bought more in November, but the good news is we're now up on our position in the fund that we manage.
And would you, and on that, in terms of sizing, would you consider sort of like top slot? Because it's trading on about 70 times PE. I mean, I know it's in a perfect position. I did hear actually it's selling its sort of like GPU chips to the AI boys at about $10,000 to $20,000 a pop. So it's printing money, isn't it? But when would you get a sort of like a position that becomes, you've done super well out of it, it becomes quite large and it's trading at a high valuation?
Yeah, absolutely. We look for a concentrated portfolio. So we have about 25 to 30 positions for our World Stars Global Equity Fund. We're looking for quality and value. We're looking for companies that are absolutely world leading. About half of them are truly mega cap companies with 100 billion, 500 billion, $1 trillion market cap. Some of them are worth trillion. They're going to go back. Others are what we call global mid caps. Smaller companies that are still global leaders. But those companies, we think we want to have them in a concentrated way so that it matters. Diversified enough so that one individual company does not have a disproportionate impact, but concentrated enough so that all the work is worth it. So 25 to 30 stocks, that's a 3 to 4% position. That's what we do when we buy. We sometimes buy half and then another half. In the case of NVIDIA, we did buy it in that kind of way, but it helped us somewhat. But because it was in the first quarter, it didn't help us all that much. It shows you actually that another point that market timing is something that is very tricky, and we're led by the fundamentals. But even when we try to do it, it's difficult. And when we look at when we sell these things, it's entirely based on valuation. So we look at the valuation of the stocks. If we think that we've come to a point where there's less upside, then we will. We've done that with other positions. But just because it's done well from a significant pullback, that's not one of them. For us, NVIDIA is now one of the top positions that we have. It's obviously one of the very top performers. But we like it at the position size that it's at right now. And so that's not a reason for us to top size.
Yeah, hold rather than trade it, because it's a world-class company. Now let's just take a step back. In terms of the AMSL you talked about, you've just got a new position there. I think that's sort of like it's photolithography, I think it is, in sort of like these huge machines, isn't it? But there is a big sort of like issue in terms of exporting these fabulous huge semiconductor making machines out to China, isn't it? How do you sort of wrap all that into it? I mean, it's got a dominant position, but is obviously getting a bit sort of like whipsawed by geopoliticals.
Yes, the geopolitical risks are things that is another thing that we have to put up with. And clearly the reliance on the global semiconductor industry, on TSMC and their manufacturing capacity in Taiwan, is a very significant issue. One of the things that is going to lead to a realignment of globalization of supply chains. We saw with the pandemic that they have gotten overstretched. I think the Ukraine conflict and the risk of conflict in Taiwan are examples that show people that we have to be more careful. And so whether you call it friendshoring or nearshoring or one of those concepts, that's happening. And you see that the US government is being very aggressive about it in terms of the support that they are giving for both for infrastructure, but for semiconductors. So there's a tremendous amount of capital that is going to be invested to create semiconductor manufacturing capacity, in particular in the US.
Yeah,
and one of the reasons.
Yeah,
go ahead.
These are all of these effectively subsidies, isn't it, for the Inflation Reduction Act to build huge, great big chip fabs out in the US and in Europe, and it's going to presumably it's only going to benefit AMSL.
ASML, yes, exactly. And in part it is because one of the things that the US has, which nobody else has, is energy independence, and the gas prices in particular.
Of course, yeah.
And the US have obviously never gotten anywhere near the problem that we've had in Europe. And so from that perspective as well, it's a very attractive place to put a fab. And so that's why we think that ASML and other providers, but we simply think ASML is the most differentiated and leading one, are going to, again, have very long-term demand for what they do, because semiconductors across the space, whether it's the GPUs of Nvidia, and Nvidia has a big reliance on TSMC, so a big stake in having capacity in the States and elsewhere, or whether it's the slightly lower spec types of applications, the demand is going to be dramatic. And that's why we think that ASML is very well positioned. And alongside Nvidia, alongside ASML, these are the more capital orientated kind of tech companies. They've gotten hit hard last year as part of this big rotation that we've had. And for people who take a long-term view, like we do, again, we want to own these stocks for 5, 10, 25 years. We've had stocks in the portfolio that the Stern family has had for decades, that I've had for my entire investment career in portfolios I've been responsible for. And so we want to own them for that kind of time frame. Yeah. And when we have opportunities like last year, where the valuations adjust for reasons that are not fundamental, then that's when we have an opportunity to buy them.
Yeah, so you've got basically a really long sort of like holding periods, and so that's secular growth. Now, another one you've sort of been waving your magic wand on is Meta, Facebook, because that's roared, hasn't it, this year? Is that going to be a long-term hold for you, or is that sort of like a tactical position?
Well, Meta has been a very long-term position for us.
Okay.
That in aggregate over time has done well, but obviously had a very significant setback. We think that in many ways, there's two things: that the fundamental business positioning, and then there's the governance concerns around capital allocation and how Mark Zuckerberg goes around running the company.
He listened to you finally there, Chris. I think he decided to get religion and sort of cost cut, didn't he?
Yeah, well, ultimately, he has a controlling interest in the company. Nobody can tell him what to do, but he's got a share price. He's got employees, and those employees have options. I think one of the things with Amazon and Jeff Bezos is that over time, Jeff Bezos has always kept a very close eye on the stock price and took it as a license to do what he was doing in terms of investing and building the company that it is. And I think it turns out that Mark Zuckerberg does have the same thing. And I think he looked at it. Of course, the tech industry in aggregate has cut costs, but the amount of headcount was enormous, and the big shift that's taken place, and Mark Zuckerberg got it wrong, but absolutely everybody in the industry, was what happened to digital advertising last year.
Yeah,
there's tens of billions of dollars of digital advertising revenues that were missing at the end of last year that that everybody thought would be there from the beginning. Those revenues were going to pay for the costs of the people and of the development. It turns out that those expectations were too aggressive. And now that reality is set in, digital advertising is here to stay. We think that it's completely wrong to think of it as a finite pie somehow that has to be divided between offline and online. When you have a company and you shift your advertising to online, you completely change your economics, right? You might be able to shut down a store. You can realign your supply chain. So it's completely different. So it has a long way to go. We've seen that. That's one of the reasons why these stocks have rebounded as strongly as they have. But the costs have to be aligned. And so we're very happy to see that they're doing that. I think for now, at the position size that Meta is, I think we like it. We think it's still cheap. It's not nearly as cheap as it was 140% ago. But for us, it's still a decent position.
Yeah, well done. Another one you've done really well on this year is Salesforce, isn't it? That's on Mark Benioff, because I think he's had some activists on his board or trying to angle to get on his board. And again, that's sort of like really propelled the stock forward this year. Do you want to take us through that sort of position? Because it's the world leader, isn't it, in CRM, cloud and CRM?
Absolutely, it's another world leader. We have a concept of an investment universe. We have companies that we look for to have the quality criteria that we're looking for: a strong and competitive, strong and sustainable competitive position. Also, always in the sense of ESG, in a good and growing market with a management with a record of value creation and a balance sheet so strong as to weather any kind of adversity. That's the key. And so Salesforce has been one of those companies. We like software as a service, and it's been on our watch list and then on our approved list for ages. But because it has the quality. The question is, did it have the value? And then with the pullback that we've had over actually the last couple of years with the rotation, Salesforce was the first of these companies off our wish list that we bought. Right, Nvidia was the next one. So that's the whole approach of how we get to these things. The investment case is very clear. As you say, it's the market leader in SaaS for CRM. It's 4 times the size of its competitors. Its competitors are some of the other biggest software and similar type of companies, but it has an unassailable, it has 4 verticals, has an unassailable competitive position in terms of the basic CRM. It has the Sales Cloud, which is attractive. It has a digital analytics business where it competes with Adobe, which is another position of ours. We love that business. And we think it has still great traction going forward. And it has a Shopify type e-commerce application that is priced and pitched higher than Shopify in terms of the scale of the businesses. And that competes with, in particular, with things that SAP does. So it has these 4 verticals that are all orientated towards the online economy and facilitating it. And again, we got caught up in the rotation that we had last year, but we think that all 4 of those verticals have great prospects and that they will drive the business forward. And then you have margin expansion potential. They had been working on that. Again, it got sort of set back by the inflation and by issues last year, but Mark Benioff has done a good job in terms of that. And we think that there's very significant potential for margin expansion going forward. And corporate governance is an issue with all of them. It's about succession. We like businesses that are run by strong leaders. Clearly, Mark Benioff has had issues finding a successor, and so there's been turnover. He's not just had one activist; he's had every activist.
Yes, exactly. He's had about 5, hasn't he?
Who's been after him, but he's clearly in one way or another gotten the message, and so he's now taking steps in terms of the business, in terms of costs, to realign them. And again, you can see it in terms of the results in the share price.
Yeah, it does. Again, seems to be a major trait of the World Stars portfolio. It's the best of the best, isn't it? You're basically selecting world sort of champions at the right. You monitor them for quite a long time, and then when they come into sort of like your crosshairs, you then sort of pull the trigger and buy it. And another one is Amazon, with obviously Jeff Bezos, who's stepped back. I think it's Andy Jassy now who's taken over the reins. But they seem to starting to get religion on their cost base. They've reduced a bit of their overhead, I think, on their cloud, but they've still got an army of people in terms of their online warehousing. They've got literally millions of people, haven't they? What's your sort of latest on this one? Because it seems to be a high-tech business that's got lots of opportunities, but this online could drag them a bit. I don't know.
Well, I think again, Amazon, they're all different, right? Amazon has its three core businesses. It has the e-commerce where it's unassailable, where some of the moat that it has comes from the capex that they've put in, whether that's actually physical cash or whether that's operating leases, but nobody has their fulfillment capabilities. And I think what we've seen during the pandemic is people get really annoyed if they don't get fulfillment. And so the ability to do that is a major competitive advantage. They have the cloud computing business where they're the largest in a still growing business. I think that one of the questions is quite how long
Fast.
will it grow for quite how much?
Yeah.
But in aggregate, there's massive demand, and at the very least, they have a cost advantage in terms of their scale. And there's no sign that there's a proper pricing pressure or anything like that yet. On the contrary. There's still strong demand, even if the growth rates are coming down. But then they have this third business, which is the digital advertising. Because if you think of it, if you're advertising on Google, it's when you're looking for something. It's if you advertise on Meta, on Facebook specifically, on WhatsApp, on Instagram, it's because you're interacting with people, and there's a bit of commerce, obviously, in Instagram, which is why it's so powerful. But on Amazon, it's at the moment you're trying to buy something. So it's the highest possible value for digital advertising, and that's been a huge benefit for them. That still has legs. So we're positive on Amazon for that basis. I think, again, it's part of the reset from last year that we've just had to get through. But in terms of the cost, they are realigning them. There's going to be turnover on the e-commerce side. Those millions of people, that's a cyclical business to some extent. So
yeah, I mean, just down the road, we have a big sort of Amazon warehouse, probably about sort of like 10 miles away, and it's by far and away the highest payer for semi-skilled in the whole area. I mean, I think
Absolutely.
it's 25 pounds an hour or something. Now, I'm guessing if you look through the sort of like the next couple of years and it goes all robotic, then actually you get all that economies of scale and you get better margins. But it's certainly, they pay a lot more for warehouse staff than anybody else at the moment, which must give them a sort of like a higher cost of servicing.
Well, I think it's the inflation, but again, it goes back to the very beginning. The commodity cost inflation, that's unhelpful, right? Because that's just a rent, and that goes to the provider of the commodities. Wage inflation is circular. We've had basically wage deflation, and the fact that we're now in an environment where there is some wage inflation, and we have effectively catch up. People in general are getting wage increases over a year or two now to catch up with the inflation. That's perfectly fine. That's how the economy works. That gives them purchasing power. And Amazon. And I'm really glad you mentioned it, because it's one of the real benefits that they're doing, is a major employer in often deprived or more remote areas where it's more challenging for people to find employment. And it's the fact that there's employment at all, and then it's the flexibility. Because what to one person is inhuman working hours, to another person is the flexibility to work at the hours that suit them and that allow them to fulfill the responsibilities that they have to, other jobs, to their families, to people they have to care for, and so forth. So I think it's a real benefit that they've got. And again, the point is, if you have pricing power, you can increase your prices. We're seeing that in a whole bunch of other types of companies, some of which we've talked about. Or you have scale, in which case you're going to do better than your competitors. And Amazon has the scale. So I am unconcerned about the price increases, because whatever problem Amazon's going to have, everyone else is going to have a lot worse.
Okay. Now, just on just turning tune to sort of Alphabet. Now, this is one which has obviously got a dominant position in search, all things sort of like, and has been a leader in AI and stuff like. When do you get sort of like concerned about potential challenges? Because there's been a lot of talk about generative AI and how it could actually potentially impact the search business for Google. And I know they're putting together Bard to sort of like offset some of the offense that Microsoft is doing with ChatGPT. What's your sort of view on sort of Alphabet and whether other sort of people in generative AI are going to be able to sort of like damage the franchise of search at Google?
Well, I think we're clearly at the very beginning of this major change that is happening. And again, as we've said, the ChatGPT is just a language, and search at this point is predominantly language based, right? Image search doesn't really work, and other forms of search haven't even really started. People can be asking at some point, like, is it really you, or are you just a chatbot? Right?
Max Headroom, do you remember him at all? I think you're probably young, a bit too young, but there was a guy in my sort of like teens was called Max Headroom, which used to introduce MTV, and he was a robot.
Indeed. Yeah, you're right. That's the early. That
was the very first Avatar, I think it was. He was quite popular, actually.
Anyway, right, exactly.
Anyway, sorry. Yes,
we're here we are still. And so my point is, it's language based. It's early days. But I think there's I think two main things to be said about it, which is, yes, of course it's an issue, which is why Alphabet, as well as all the other companies, is spending billions of dollars in terms of software development. So it is part of the future. The second thing is that it does not seem to me that it's clear at all that anybody is going to have a clear competitor. It's a technology, it's algorithms. ChatGPT does work very well. Also, its moderation engine works really well, so it doesn't give you inappropriate answers the way a lot of the other ones do or seem to. So it works very well, but it's just one. And we don't think there's any indication that there's going to be a winner in that particular race. All the likelihood is that the companies will be able to come up with something.
Yeah.
But the second thing is, and I just recently had it, I was looking for something, I was unhappy with the Google result. Because I asked a kind of question, and I went into ChatGPT to ask the question better, and I got a really nice phrase. But this was the second point I was going to make. ChatGPT at this point, it can give you a nice phrase to identify something. If you're looking up some knowledge-based thing, it can actually give you an answer, and it's a bit more specific than what Google can, because Google refers you to websites, whereas ChatGPT is curating an answer for you. So that's helpful in certain settings. But the link to that, to search, to results, to algorithms to find websites and so forth, that's a whole nother thing. There's no ChatGPT is the front end effectively for typed language-based search. I have no reason to believe that Alphabet isn't going to be able to crack that. And therefore, again, I think it's one of these things that gives you opportunities. And I also have the confidence that Alphabet, if they're either going to crack it themselves or they'll buy someone who does, and they will layer that language functionality into what they do. Alphabet and everybody else, and I said it just a moment ago, has been after image search for decades. How many people do we know? I certainly know several who've been in image-based startup companies, some of which they've sold for a lot of money to companies like Alphabet. So that's perfectly fine. But in terms of the output we've seen for consumers, it's not there.
Yeah, no, it's
because we're not there yet.
Yeah, no, you're right. It's absolutely rubbish. Now, just turning to sort of like this neck of the woods in terms of the side of the Atlantic. You've got Diageo, which is obviously a big UK spirits maker. I think it does Smirnoff and Guinness and people like that. Now, what's the sort of thesis on this one? Because it's never really, but it's got dominant position, great brands, but it's never really sort of had huge growth, I don't think, other than obviously when the bars reopen, then clearly it's been doing well recently.
It's actually been really resilient all through the pandemic, because it's on trade and off trade in terms of consumption in restaurants and bars and other hospitality venues versus just drinking at home. We have one of these sort of pillows at home that says it's not drinking alone if the dog's at home. You can take comfort from that if you have your pint of Guinness or whatever, which we encourage you to do.
Okay, I might well try that.
No, we look for different things, and I think that's a really important point to understand the overall positioning and how we look at things. We again looking for quality and value, but there's different types of businesses. There's higher growth businesses, like some of the tech companies that we've talked about, and that's how they generate their value. But there's also businesses that have very high quality and that are very attractive because they have businesses that have much longer duration. And those are some of the consumer companies that that we can talk about. Diageo is one of them, but we obviously have a whole bunch of others.
Yeah.
And there, they have the opportunity to grow and add value at lower rates of growth, but over much longer periods of time. Because we don't believe in growth for its own sake. We think that growth is an attribute of value. I said good and growing markets is our second criteria. That's how growth comes in. And Diageo is one of these companies. It's very sustained. It's the largest in the industry, in particular in the US, where distribution is part of the moat that you have. They're very entrenched. So they have great brands that they can support. They have, therefore, lots of economies of scale in terms of all the types of things. Production, which is not even so important, but in particular, brand support. It's a bit like Nestle in that kind of way, that it can support its brands. It can reinvest and afford to come up with new ideas and categories and innovative products. And we think that that's attractive. And then the third thing is that it is also a very global company. It's the only UK listed stock we have at the moment. But obviously its UK exposure is small compared to the overall revenue base. And so it also has a global footprint that we like a lot. So from that perspective, it's been another long-term holding for us. But it is more of a compounding type holding that adds value that way.
Yeah, it's got fantastic margins. I mean, 30% EBIT margin, which says everything. That brand is so sustainable in terms of, and it's got that affinity with consumers. Another one which I think reported some fantastic, in fact, blockbuster results about a week ago is LVMH, which is, you know, I think the shares responded very favorably. In fact, it's almost got margins of sort of like, you know, 30%. Take us through that one, because again, I guess it comes down to sort of like, you know, whether the question is, it's a brilliant company. It just is what price you pay for it and whether you top slice, I guess.
Well, yes, but again, long-term holding and wanting to compound. Look, if you think of, you know, in our business, think of and we're coming up to the Berkshire Hathaway annual meeting in Omaha, right? It's the beginning of May every year. It's where Warren Buffett and Charlie Munger get together, and 60,000 people come. I go every year as well. And they, you know, and you basically go and hear from them. How they run their business, and you come off thinking, you know, that's not a bad track record that they've had, even if it's, you know, different things, and you might agree or disagree with some individual decisions that they've done. But if you look at the track record that Buffett has had and the value that Berkshire, a company like Berkshire, has created for shareholders, or you look at our portfolios and you look at a company like Nestle, which again, the Stern family has had for generations, that I've owned throughout almost my entire investment career. The value comes from the compounding. It doesn't come from the top slicing. You got to own it. And so our goal is to own these companies over long periods of time. We've owned LVMH since about 2019, and we intend to own it for a very long term. We think that it has lots of legs to go. And one of the things that's driving it is, I mean, it's obviously the innovation. It's the desire of people to have these relatively affordable luxury products. In Europe, it's established. There's a lot of tourism in Europe. There's going to be shifts when people from Asia, and particularly from China, get to travel again. In the US is an emerging market for luxury in terms of its penetration.
Wow.
And China, Asia in general, and China are enormous markets. And China is coming out of the lockdown with what we think could be between 5 and 10% of GDP in excess savings. And so one of the things that drove the results, but it's only just started, is this Chinese demand. And so there is a lot of demand for high-class products at fantastic margins, and we don't see that changing.
Yeah, I think you raised a really good point in terms of, you know, the philosophy of the world stars with the sort of the Buffett philosophy. If you've got an absolute winning horse here, thoroughbred, then with just so dominant positions worldwide and attractive brands, then just ride it out through the ups and downs, because the passage of sort of like the least point of resistance, the line of least resistance is upwards, isn't it? Upwards to the right. And you've seen that with Nestle, and you've seen it with LVMH, no doubt about it. Now, just let's move to sort of healthcare, because again, it's another big sector in the portfolio with secular growth. And I did notice you've got sort of like some good sort of like a mix of pharma and diagnostics. Let's start with Roche, because that's sort of like is actually quite cheap. It's on about 14 times PE and was a real COVID beneficiary. And I think that's probably that hangover is probably coming out the stock, I guess, and it's sort of like, you know, based out. What's your latest on Roche?
Yeah, it's Roche is trickier. We like healthcare companies. The big areas we invest in are digital transformation, our consumers, broadly speaking, are healthcare and life sciences and industrials, which is important because we do see lots of opportunities there as well. But in healthcare, it's healthcare and life sciences, and we prefer companies that are in things like diagnostics or equipment or services to companies that are in ethical pharmaceuticals. Because the development of ethical pharmaceuticals has become extremely difficult. It's become very expensive, very time consuming, and the outcomes have become very difficult because big therapeutic categories have already been addressed, and the ones that are now open are complicated, are often related to biologics, are often related to the central nervous system, and these are areas that are very difficult, where there is great variability of outcome. And so the investment thesis on Roche, it's been a long-term holding for us as well, has been around these different legs that it has. It's been around the pharmaceutical business, where they had a fantastic franchise in cancer, but where they have had a patent cliff that they've had to get over. They've had a couple of pipeline products, in particular around Alzheimer's, which would be
they got it's
really $1 trillion scourge to the world, and as and when we find things to address that, it's going to be an extraordinary opportunity for the companies that can succeed. But unfortunately, their products did not. So they've had bad news on the pipeline, and that impacts the stock price. And their diagnostics business is very attractive with great scale. And you're right, it's one of the ones that has benefited from COVID. We've had others. We've had Thermo Fisher, for example, that has benefited significantly. We've had Becton, we've had Medtronic. These are other companies in the same space that have also benefited. But on the road, but that is offset to some extent these issues on the pharma side. For us, Roche right now is one of the steady companies in the portfolio. It's among the very cheapest, and it has a strong balance sheet. It has a very attractive dividend yield, and in the environment we're in right now, where we have some of these high growth companies that are delivering great value this year, as we've just seen. We have some of these compounding type companies that we've talked about. We also think that there's space in the portfolio for a company that has a somewhat slower profile. It's now very, very cheap, and we think that it's over discounted. There are a couple of milestones coming still in terms of their pharma pipeline, and we think those are the next things. But we will evaluate it over the course of the year because there is pipeline news coming, and we want to see what they're going to be able to deliver.
Yeah, I mean, I could certainly see sort of the life sciences and the diagnostics as the world does more elective procedures. That should be at least some sort of tailwind, regardless of how the pharma sort of like positions itself. Just as a broader issue, in terms of when you run a global fund, and this is really sort of like for investors, I guess, is sort of like if you get paid dividends and the local sort of like, country decides to have, put withholding tax on dividends, how do you actually sort of manage that just for sort of like investors? Because, when it comes, does the fund, I don't know, it's UK fund, does it basically aggregate the dividends from abroad and then, and claim it back? Is that how it works or something? How does the withholding tax on dividends work?
Well, I think it very much depends on the jurisdictions.
Yeah.
And it's a question for the fund administrator. We try to maximize that. But because it depends. That's why you have funds that are structured in different ways. You have OICs that are focused on the UK only. You have UCITS that can be sold in lots of places outside of the US. You have structures in the US itself. So it can't be answered in one straightforward way. So it very much depends on each of these individual structures. And all we can do is work with the administrators and try to benefit from arrangements and treaties and so forth, in the same way that every other fund does, to have the least tax impact that we can have. The benefit of a fund, obviously, is that you roll up capital gains. It's a different issue. But you can buy stocks, and unlike if you own them yourself, if the fund manager changes their mind, then you can make a change, but you as the investor don't pay capital gains tax if you realize results. But dividend and dividend withholding is a difficult subject, and you have to distinguish between gross and net dividends, and in many cases we end up with the net dividends in terms of what we are able to receive, and then also obviously in terms of the tax treatment for the investors and what they actually get.
Yeah, well, I think it's an important point for investors, actually, because it shows you the benefit of if you decide to go for a collective like World Stars Global, rather than actually buying these huge, great big businesses individually, then all the administration for that tax on the dividends is sorted out, plus it's done in the most tax efficient way, and the investor doesn't see it. So yeah, that's a big sort of like tick in the box for going for the actual fund rather than the individuals, because it's, just from my own personal experience, it's a pain in the proverbial to have to do all that, trying to contact the local tax authorities, particularly.
No, of course. Well, you have lots of line items, right, on the one hand. And so obviously we deal with that, but I think the main thing is the deferral of capital gains. Yeah, right. Good. As you say, we do trade actively. We buy stocks when we see opportunities like we've had. We sell ones where we think they've been resilient, or where the value isn't as where the value target has come, or where we've made mistakes, which happens from time to time, or where we see better opportunities. But when we do that, then that doesn't necessarily create a capital gains liability as it would if you had a stock and you said something. I've had enough of this one, I'm going to buy some more of that.
Yeah, and it stops the investor having sleepless nights as well, because the person who's running the fund can have the sleepless nights, which is always quite nice as well. Now, another one which is in the portfolio, it's a really a unique asset, and it's what, 100 and, well, I can't remember, about $180 billion. Walt Disney. Now, this is quite a sort of like a battleground area, because obviously it was late into streaming. It's got its brilliant assets of all its sort of caricatures and the beauty of obviously Disney and its parks and stuff like that. But it came late into streaming, and now it's playing catch up, and it's costing them an arm and a leg. Which is the latest on Disney, because it has still come down quite high from about 150, I think it was at one stage. It's about $100 or just south of $100.
Yeah. No, it's been a roller coaster. I think it's been. Walt Disney is obviously one of the world's greatest entertainment companies. Its big franchises are the basic movies and entertainment that they provide. It's the ESPN and the sports, and it's the parks, which is obviously an extraordinary business. And you're right, they've come relatively late to the streaming compared to the likes of Netflix and others. But when they did it with a vengeance. Because they have these franchises, right? So they are unlike the other streaming companies. They own the Star Wars franchise. They own the Marvel franchise. They own the Pixar franchise. They own the Frozen franchise, which may be part of Pixar, can't remember. So anybody who has, well, pretty much anybody, but certainly anybody who has kids knows that what I think Walt Disney and certainly Disney Plus has in common with Lego is that it's a tax on parents, because once you turn it on,
you're right,
you do not turn it off.
Yeah,
I mean, you can try, but you'll have a sort of you'll have a Star Wars type rebellion on your hands, basically, if you do that. And so that's a real benefit to them. On the one hand, they've invested a huge amount of money because they've driven the expansion. They effectively decided to go for a land grab in the States, but also internationally. So Europe and India in particular, they have much lower. They priced it low to begin with to get that land grab. So they've invested in it, and they priced it even lower, especially in India, to entice people there to get their entertainment from it. They've succeeded in terms of numbers, and they're now addressing the profitability. The numbers that Bob Chapek basically was dealing with in the third and fourth quarter of last year were not so far off what Bob Iger was going to deliver. So it's more around the turmoil there, I think, was more around the confidence, more around Bob Chapek, how Bob Chapek was managing things, rather than necessarily these cost issues that made the headlines. But there is efficiency. And one of the things you can see with these companies, and it's a real learning point, I think, it's something to think about, as we analyze them as professionals, but it's something I think to really think about in our lives is they take decisions in very short periods of time. So, for example, the decision that Bob Chapek had to be replaced took place in a matter of weeks and months. And it's something that properly gives me pause. What do I think in terms of really important decisions in my life, whether it's business or private, that I take these kinds of decisions in that kind of time frame? That's decisive, right? We look at these companies, all of these cost cuttings, and obviously Bob Iger has now implemented those in Disney as well. These are things that are done in matters of weeks, not even months, in terms of adapting at huge scale and complexity to changes in the business environment. And I think we have to give companies some credit. Last year, I think, was a moment where we didn't, where for lots of reasons, the rotation, the rates, the media, these kinds of things, we didn't. But you can see companies across the board, and I include Disney in that, acted decisively. You saw Nelson Peltz, who after all is known as Brooklyn Beckham's father-in-law. He who is a true activist who takes large stakes in companies, not small sort of fleeting ones. Wanted to get a board seat, was going to embark on a proxy battle that was going to cost hundreds of millions of dollars. And said this year that it was okay, that Disney had in fact done what he would have wanted them to do. And so even one of the really most experienced and most impressive activists in the world said, it's okay, they've acted. And so we're positive about that. And you can see the movie franchise is what it is. The streaming is going to be robust, and it's going to be one of the winners with pricing power. And very importantly, and it goes to what we're talking about with LVMH earlier, also with Diageo, which we touched on, is that the basic consumer is pretty healthy. The parks are sold out.
Yeah, exactly. And the prices have just been
yes, and prices are rising, and people are paying them, and incomes are rising. The profitability went down last year. Because one of the things that happened, and we hear that from companies, I hear it from entrepreneurs I speak to, is there's just a time lag, right? So your costs go up very quickly. Your commodity costs go up almost immediately. We've all seen that over the last 12 to 18 months. Your wages do not go up as quickly. Many people have seen that to their distress, but now in the UK and elsewhere, wages are rising as well. And prices go up over time. It just doesn't happen at the same moment. And so last year, again, and that's what I said at the very beginning, we've taken the hit on a lot of this. We've also taken the hit, I think, to a significant degree on that, because the big squeeze, where revenues are flat but costs go up and margins get compressed, that's exactly what hit Disney last year. And that's what we're now seeing, that costs are being managed and addressed, but it takes time. And over time, prices are being increased across the board, especially in the parks. And so the profitability is going to get protected. Will the margins increase? Don't know. But will they be resilient? I think that's how things work. And that's why we think that Disney itself is very attractively positioned, and at the valuation where it is right now, we think it's an attractive investment.
Yeah, I think the pricing power for somebody like Disney is absolutely fabulous, because you just say your kids vote, and it's difficult for you to actually argue about it. But you also raise a really, really good point for investors in terms of, stock picking, choosing the right captain at the helm, the right management team, because if they've got to take sort of like instinctive decisions in short timescales, because of the environment and the industries are changing, and digital transformation, this whole industry cyclicality is moving that much faster, then it's important that you choose the right people at the top. Otherwise, it doesn't, the business, the wheels will fall off the business, I guess.
Yeah. Well, I think that's right. That's our third criteria is a management with a track record of value creation. As one of the attributes of quality, and that's exactly why, because you need people who are able to adjust things. But again, we do have to make a distinction. The underlying franchise of what a company does Criteria 1, strong and sustainable competitive positions. Criteria 2, good and growing industry. That doesn't change.
Yeah.
That's long-term. That's 5, 10, 25 years. You've got to get that right. But the adjustment of that and saying how should we be running our businesses? Have we actually made a mistake? Have we increased our cost base too much? Because we've overhired, because we thought we had the revenues and now we don't. Those kinds of decisions have to get taken very quickly. In the States, they get taken very quickly. In well-run companies in Europe, they get taken quickly as well. And that's the kind of management that we want to back.
Yeah, no, totally agree. And just to touch on a couple of other areas, because I know you've got quite a good sort of like, portfolio of diversification. Defense, we've got, and sort of like commercial aerospace, Raytheon. What's your sort of latest view on that one? Because obviously it's had a bit of a boom time sending probably selling missiles and armaments and arsenal out into Europe. But if that was ever going to have a ceasefire, I mean, who knows when it is, that may change the dynamic, or wouldn't you see that because of obviously the potential risk of sort of like, China and what's happening out in the South China Sea?
Well, I think that it goes back to very fundamental things. We have a strong commitment to sustainability. We've fully integrated those kinds of considerations into our investment process in all the ways that one should. And we believe that sustainability, again, it's like growth is one of the attributes of quality through the good and growing industry. Sustainability is an attribute through the strong and sustainable competitive position. So we completely believe that only companies that are sustainable about how they go about their business and sustainable about how they treat their people, their resources, their other stakeholders, can have sustainable competitive position and generate sustainable returns. And like so many things, the clues in the name, it's the E, the S, and the G, and in this case, it's the S. And having a stable geopolitical system, having the ability to maintain security is one of the key things that goes into that S. Yeah, okay. That is a thing. And so we've always taken the view, we have to be very clear about that, but we've always taken the view that there is a role for defense. Because it is important in terms of governments to be able to create the environments, to have rule of law, to have stable markets, and to deliver prosperity. And so that's why we have always felt that companies that are responsible about that, like Raytheon, are companies that we can invest in and that they're fully compliant. People might disagree because they may have their personal views of the type of company they want to invest their money in. And those are very serious considerations that everybody, again, whether it's a large institution or a pension fund or whether it's an individual saver, they have to decide that. But from our perspective, we think it's compatible with investing in a sustainable way to invest in companies that are involved in defense. Oh, yeah. So I think,
I totally get it. You've got to have a deterrent, haven't you? I mean, basically, otherwise you'd have just chaos in the world. So yeah, I mean,
well, you need to be able to defend your interests and your the way the
democracy,
very least to be able, again, at the very least to be able to operate your country in the way that your people through your system and your elections want you to. And so that's an important aspect. And that, unfortunately, is not going away. On the contrary, clearly the geopolitical tensions are high. Again, we have a very long-term view. I grew up in Germany during the Cold War. I used to carry a wallet with me that said "Made in West Germany," because that's where I grew up. And those were real tensions, right?
I remember that.
Many of us will remember that. Some of us won't, but many of us will. Those were real tensions, right? There was real conflict. There were real proxy wars all over the place. There were troop stations that you could see. There were missile silos. There were all sorts of things, and lots of things could have gone wrong. And then it was some kind of human error. Now it's AI. But there is, we had the War Games, the movie. Right now, it's more like reality. But still, these things are things that have been around, and if you have the perspective, you can evaluate that. So we think the demand, unfortunately, is going to be there for a long time. Ukraine has highlighted that. There's a huge shortage of all sorts of things. The types of missile systems, in particular, that Raytheon provides, both the hardware, the software, the guidance systems, and so forth, are the way in which to operate. in those kinds of theaters. So there is a great demand and a great need for innovation. And so we think that has a long runway to go, because these conflicts are not going to go away. And again, countries are going to have to prepare for that. But in Raytheon, that's about that's just more or less half of what they do. The other half is commercial aerospace.
Yeah.
And that is also recovering very strongly. It's a cyclical business, but they're in aircraft engines through Pratt & Whitney. Yeah. They're in avionics, and they're in parts of the servicing of these things. And those are also businesses that have very long trajectories ahead. And that's why we think that that's a business that is very attractive. It's been one of the stronger performers recently because of the tragedy of Russia's invasion of Ukraine. But if that hopefully gets resolved, if it ends up in a ceasefire when different sides have achieved different objectives, then I don't think that it will not change the need for countries, the US and other NATO and European countries, the customers of Raytheon. It will not change their need to keep on investing in their capabilities.
Yeah, no, and I think on the commercial side, I mean, the order books for Airbus and for Boeing are just absolutely enormous, thousands and thousands of planes they need to be able to deliver, and clearly that's going to help that whole commercial area. Now, just finally, then, just turning to sort of like the industrial side, we've had there's a lot in the talked about with the commercial real estate sector being soft. I was just wondering what your view is on Otis, because obviously it's the world's leader in all things sort of like lifts and escalators and stuff like that. Just is this a sort of like a classic razor blade model, or is it actually dependent on new build?
No, exactly. We like businesses with that have recurring revenues for whatever reason, and elevators and elevator servicing is one of the classic razor and razor blade models, right? You have the OE equipment, original equipment, where you put in the elevator, and then you have, if you can then get the maintenance contract for it, you can have decades of service revenues and maintenance and spare part revenues at much higher margins. And so companies don't really disclose that, but our estimates are, as you wouldn't be surprised, that the OE business is very low margin, because effectively you give away the razor for more or less free, because you're going to get the blades, the recurring revenue from the servicing. So that's very much what it is. One of the things that is important for all of the elevator companies, but in particular for Otis, is that a lot of it is about refurbishment. So you can't forget, if you look at the installed base of these elevators, yes, OE matters, but they make the least money on that. It's the biggest headline number that you've got. They make a lot higher margins on the refurbishment of elevators and the replacement, because it's more complex, it's more bespoke. You don't actually just compete. You don't just get the 4 major competitors in and sort of choose the one that you like best, that perhaps gives you the best price. But it's a much more complex thing, because you've got a legacy system, you've got a type of installation, and those kinds of considerations to make. And then on top of that, you have the service business. So I'm not so concerned around the weakness of commercial real estate. On the contrary, one of the things that happens is when you have fewer new builds, people refurbish, right? Because you need to invest in that, and the pent-up demand for that is extraordinary. Yeah. One of the things we've touched on, I alluded to it, is this need for investment, right? You've got you've had globalization, you're in the middle of digitalization. You have a tremendous need, and it leads us into the industrials, for capital investment, because the US capital base, and the same applies to Europe, the same applied now also to China, is the global capital base is as old as it's gotten, and things are crumbling. So existing capital infrastructure, public and private, I mean roads, I mean airports, I mean ports, I mean simply bridges, the capital infrastructure around here. I live here in London. Think of the Hammersmith Bridge that is now closed for years. Let's not get into it.
It's terrible.
This infrastructure has to be renewed. And that's before we talk about the forward-looking challenges: climate change, automation, aging, efficiency, productivity. And I look at things, I'm positive because I'm optimistic. The famous Churchill quote, I'm optimistic because I see no point in being anything else. But I see it as an opportunity because we have developed a lot of the technologies in order to take care of these past issues and replace them, but also to address the future issues around climate change and around productivity and so forth. We just haven't been producing them and implementing them at scale. And that is the thesis behind almost all of our industrial holdings, where we think they are the shovel providers to these kinds of things. Like in the gold rush, right? You don't want to be mining or
you want to be doing the picks and shovels,
gold, right? You want to sell the shovels, and so that's why I think there's a lot of trajectory ahead as you look at these businesses, and a lot of opportunity.
Well, I think you're at the smart end of that, actually, because I mean, I'm just looking at Otis and it makes sort of 15% operating margins, which says they've got something discernible and it's something unique, because it can charge it, because obviously you're just a standard sort of like, contractor, it's 2 or 3%. So it's choosing the right spots in that whole sort of transition. Okay.
Yeah, well, we think the increment, and that's the blended margin, right? I think the aggregate margin, the actual margin on the service side, on the spare parts side is much higher than that. But you've hit it on the head. That's how they get to these margins. And again, scale, all these other considerations. So I think there's a tremendous amount of benefit from that. But it's that third phase. It's this capital investment phase that's really important, and we have a very high conviction in it, because I think as you look at your portfolios, of course, you look at digital transformation, and there's some great companies. Platforms and more cyclical companies, more capital intensive companies like Nvidia or ASML that we've talked about. You look at consumer products, it's clear, great opportunities. You look at healthcare and life sciences, also quite clear that there are businesses that are leading it. But I think the area that we certainly have always focused on, and that I think people should focus on as an area of opportunity, is these industrial stocks, because there is a 25-year opportunity ahead of us. That is trillions of dollars of investment to tackle these challenges.
Yeah, I think it's what also is quite interesting, actually. Just a quick note on it is you don't actually select any of the sort of traditional energy, oil and gas, transport, utilities, REITs, or house builders, anything of that sort of the old, which has got a more cyclical tilt to it rather than secular. Is that the reason why you don't? Or you've gone for your world class, your top secular growers, haven't you, rather than anything of the old traditional?
Well, it goes back to the quality criteria that we've got, and we think quality has to be forward looking. It doesn't help to have companies that have quality because they had it in the past. We've got to think about the ones that are going to have quality going forward, and especially as you think about managing money for the long term, as we do, that's one of the real challenges, is to be forward looking and not to be trapped in what has worked. That's, I think, one of the aspects of that. But I think the other aspect of it is that we also don't like it. The criteria that we have take us into the companies, the types of businesses we're invested in. It takes us away from others. It takes us away from highly capital intensive businesses. It takes us away from high fixed cost, low margin businesses. It takes us away from government influenced or regulated businesses. People invest in concession type companies. It takes us away from utilities that have huge amounts of capital that is often stranded and gets disrupted. If Germany decides from one day to the next, as it did a couple of years ago, to shut down its nuclear power, there are remediation liabilities to basically get rid of these nuclear power plants.
Yeah, the decommissioning.
Exactly, revenues. Those were on an Excel spreadsheet.
Yeah.
Those were numbers on a spreadsheet that showed up in a balance sheet. And there were some numbers, and people changed the numbers, and that's what they were. And suddenly it's cash because the government changed its mind. This is risk that we're not willing to take. And then we don't like extractive resource companies because we think they're in the process, not because we wouldn't invest in them. We think they're getting disrupted. I think there is no question that there's an energy transition. It will take decades. But the big oil companies are not replacing their reserves. There is unlimited shale oil in the States. So unconventional oil and gas.
Hundreds of years, isn't it?
hundreds of years, unlimited for all intents and purposes. There is a marginal cost, there's an environmental impact and so forth, of course. But the marginal cost, it's, people can look at it, but it's likely around $45 to $50. It might be less of a barrel of oil equivalent. So that's what the long-term price of oil is going to fluctuate around. And that means that all of the non-conventional oil that is deep offshore, that was, 10 years ago, what all these big companies were investing in, the big, in particular, the big international oil companies, or the Canadian oil sands. These things have much, much higher cost per barrel. And so we think that's in the process of getting disrupted. And that's before we get to carbon offsets, which I think is going to be a defining feature of the next decades ahead. And that's before we have the renewables. And it's before, and I'm just going on, it's before we have technological solutions.
Yeah, I think you raise a really good point. I mean, it's important that you decide your criteria and where you're going to invest your money, but it's equally important where you're not going to invest your money. And in particular, in places like oil and gas and REITs, you might have a lot of sort of like, very cheap stocks, but they're cheap for a reason, because they're not going to grow, and they've got some sort of like, potential disruption coming down it. So I think you've really highlighted, you've got to play both sides, what you're not going to buy as well as what you're going to buy. You have to be clear. And I think that's the point, and that's why I think also conversations like we're having are helpful, because you gotta see what people do. Yeah.
And I think the very important thing is to have clear views, to have clear criteria, a clear statement and conviction in terms of what you do, and then I think as an investor, that's how we look at companies. And as an investor, you can then, I think, look at funds and fund managers and say, is this something that I believe in? Does it have a part in my portfolio?
Yeah, no, I think you've been absolutely crystal with me. So I really appreciate your time there, Chris. And if investors want to sort of put some money into the World Star Global Fund, how best to do that? Is it through an IFA, or how best is it contact you or contact Jay Stern? I don't know.
Well, we're widely available. So we have a website, www.jsternco.com, that people can go to, and it has a lot of information. We have the World Stars Global Equity UCITS Fund. We have that in different currency share classes. So if people want to invest in a pound, a dollar, a euro, or a Swiss franc share class, we've got that. We don't hedge currency because we think the companies do that themselves. Yeah. One of the important points from, I think, an investor's perspective, especially from a UK perspective, is to be diversified in that sense as well. What's the point of investing in companies that do business globally if you're going to hedge that back into pounds and then take the risk of that you have with that here? So people have that. We are on a number of the big investment platforms here, so we're readily available on some of them, and you can find that on our website. We are also on the approved list of a number of wealth managers that people may already have accounts in. And I do encourage people to get in touch with us if they're interested in investing, and if they can't find the information they need. Please do get in touch through our website, and somebody will get back to you, and we will try to provide you with the information that you need.
Brilliant. Well, thanks very much, Chris, and look forward in chatting in 6 months' time, and hope you get home okay over Hammersmith Bridge.
Indeed. Okay. Thank you very much.
Take care. Bye.
Thanks. Bye.